Well, this is great. Thank you guys very much for the early wake-up call to get out here for the first session of the day. This one is one that I've been very, very, I guess, optimistic and looking forward to ever since I got slated for this program, because we get to speak with three of the probably best macro-minded and in some ways is micro-minded people out there. Brian does pick stocks every once in a while, and we'll name them for a living. The purpose of this conversation today will be to frame, I guess, the outlook for global economic policy, geopolitical risk, and how it all impacts the markets in various ways, whether it be in equities, bonds. Maybe we'll touch on crypto at some point, but we'll leave that for later on. But anyway, we will save some time at the end for Q&A if anybody has anything, but we'll maybe start off the conversation a little bit with a more open-ended question. And Gabriella, because you're kind of down there, I'm going to start with you. Do you feel generally constructive about the way things are shaping up from a macro perspective?
Thank you, Dom, and good morning, everyone. I would say generally constructive that we'll get to being more constructive, if that's kind of a roundabout way of saying that right now we're what we would call kind of in the thick of a policy fog. We have a new administration. We have several policies being rolled out here in the U.S., which are starting with some that can be a little bit more challenging from a macroeconomic and markets perspective. Things like tariffs, cuts to government spending, restrictions to immigration. But of course, we'll eventually get a bit more clarity. Companies, consumers, investors will adjust. And then, of course, we'll be able to see some better risk performance. What we feel constructive about is that we've come into this policy fog with, honestly, a pretty good backdrop in terms of the economy and earnings, right? Last year, not only was there no hard landing, but there was quite a high-altitude flight there where the U.S. grew nearly 3%. We ended the year with consumption at 4%. And importantly, in the fourth quarter, we started to see earnings growth very, very strong and importantly, broadening out from the Mag 7. So we're in a good place. We're just sifting through a little bit of policy fog. The markets anticipate this. We're seeing a bit of multiple contraction, some volatility and moves when it comes to bond yields and the currency. And eventually, as the year goes on, that'll get priced in. And perhaps we'll get some of the more business-friendly aspects of policy as well. Things around tax cuts, deregulation. Where we do feel a bit more optimistic, if I may, is some developments overseas. This is the best outperformance of international versus the US, going all the way back to 1990. Not because I think the US is a disaster, the rest of the world's amazing, but just given high expectations for the US coming into this year and basically basement expectations for everywhere else. And we're getting pretty excited about some of the changes we're seeing in Europe. Really, Europe being pushed by US policy to make some hard necessary changes around fiscal spending in places like Germany, defense spending, and maybe we could actually be in a cycle of upgrading our expectations for European growth and European earnings.
All right, so with that in mind, there has been this outperformance as of late, and maybe some would call it a mean reversion trade, right? I mean, there's been such underperformance versus the U.S. and other key markets around the world that this is maybe just kind of like that catch-up, that kind of moving back to long-term historical trends. Emily, building on that, if you have a situation where we've been talking about American exceptionalism, that's the term that's been used a lot with regard to why the U.S. and its trade policies, its proposed tariff policies, its general corporate governance policies, its administration's relationship with the business world's policies, all of those are supposed to be massive tailwinds for the American economy and markets overall. We've seen that leading up to the election. But now, since the election, things have really kind of stalled out a bit. And that American exceptionalism has now maybe taken a bit more of a backseat to this global exceptionalism, if you will. Is this a near-term phenomenon, or do you think this is something that takes longer to play out?
Yeah, Don, we do think it's a bit more of an... Oh, you. Good morning. We do think it's a bit of a short-term phenomenon, and there's a lot of give back right now. You saw what happened post the U.S. election. There was this rise in animal spirits. You saw this massive rotation into U.S. equities out of non-U.S. equities. The dollar surged. We saw interest rates back up on this idea of more pro-cyclical policies and deregulation and American exceptionalism. Things like regional banks were up 30% in a matter of weeks, and those are highly levered to deregulation. So what you're seeing now is a little bit of a reversal of that trade. You're also seeing us get kind of the tough part of the Trump administration agenda. Has anybody ever decided to give their kids dessert before they eat dinner? That's what we do in my house because I kind of like to get the sugar high out of the way. And that's what's happening. Now we're getting the potential tariffs. We're getting some more fiscal austerity potentially in the United States. By the way, I've never used the word potential more in like my entire career because we still don't know. So we're seeing this massive rotation that's not based on fundamentals entirely in our view. I mean, Europe and China, Europe's outperforming the United States by 18%. 18% year to date. China is trading on another planet right now, and the fundamentals are not exceptionally better overseas. And if we are experiencing a global growth slowdown, the rest of the world is just not immune to that. We don't have an economic contraction in the US without the rest of the world experiencing it. So I think what we're seeing right now, it kind of feels like a rerun. Brian and I were talking about movies backstage. Anybody love watching reruns? I just started rewatching The Sopranos on the plane last night.
Such a good show.
It's the best show. I'm so excited. But it feels like a little bit of reruns. We've got Europe, the US's reruns from 2023 and 2024. We have Europe and Germany excited about an election. Okay, that sounds familiar. We have China excited about AI with Alibaba and Baidu accounting for most of the outperformance in that market. So I think some of the moves that we're seeing are so parabolic that they're not likely to last to this magnitude. We still prefer the US, we still prefer high quality stocks, and I'm sure Dom will talk about that a lot.
Thank you. And perhaps, so I focus a lot on international, which made me extremely unpopular for like 15 years. One of the questions that we've been thinking about is this idea of reverting to the mean or this period of rest of world exceptionalism. Is this just kind of unwinding the move that happened since the election? That's what we've seen. So Mag 7 down, the rest up, US down, international up. Or is this unwinding some of the moves that we've seen over the last 5 years, which was all Mag 7, everyone else did well, but no one noticed? Did you know that Europe and Japan outperformed the US since 2022 if you take out just NVIDIA? So is that what we're kind of unwinding, this lack of just pure Mag 7 exceptionalism? I'm a bit more convinced of that. Or are we unwinding the last 15 years where there was this huge US outperformance of nearly 300%? That's what we're testing and learning. And I think there's some more arguments for Europe, Japan versus China. That I would put in a very different camp.
All right, so that begs the question, Brian, for somebody who it's not that we don't look at individual stocks on a daily basis. It doesn't matter if you're macro, micro, anywhere in between. You're still looking at components. But generally speaking, there has been more and such an intense focus on just a handful of those names. It's a narrative that is not new to anybody in this audience, but that Mag 7 so-called trade has been a driver. If you look at the way things have shaped up in the last, say, 6 to 9 months with the markets the way that they are, it seems as though there has been a renewed focus on things that are not exactly Mag 7. And I wonder what you think that says about sentiment and about why investors and investment advisors are moving towards other parts of the market, seemingly.
Well, hey, thanks for having. Hey, Dom, how are you?
Hey, Brian.
Handsome. Thanks for having us. Just to let you know, the first thing you're supposed to not do when you speak is apologize. So I'm going to apologize because I work for a Canadian bank, and we just typically apologize for everything, even though I'm an American. So
it's not the 51st state, though, right?
No, apparently they're not for sale, but I don't believe them. Anyway, I would say this. I have a little bit, I can't do this on TV, but I can do this when we're talking like this. I have a little bit of a different speaking style, so if I offend you, I'm sorry. It's kind of half Jesus Christ, half Deadpool. So I may throw out some scripture, but I'll certainly throw out some pop culture. So you just threw a bunch of topics out that we can talk about. So let's throw a little pop culture out there. If you've ever seen the movie Taken, my comment on investing outside the U.S., good luck. Anyway, so here's what I would say. I've been doing this now since my 36th year. My very first riff on Wall Street that I saw was June, July of 1990. My first bear market was 1990. My first time speaking in front of an audience was July of 1990. My first time that I put my official forecast at the top of the piece of paper, 1998. And so I've been doing this for a long time, and for some reason I keep getting all these jobs that keep me employed. I have no idea why. But at the end of the day, I'm really trying hard to not be the crabby curmudgeon. And here's why. What I believe is happening is, and here comes the pop culture, here comes what I'm not supposed to say. A lot of people don't know shit. And so what I mean by that is, the market has changed. When I learned the market originally, Bill O'Neill told me that the smart money was institutional and the dumb money was retail / private wealth. It's completely flip-flopped. Okay, so you talked about sentiment. Sentiment's a bunch of bullshit because I'll tell you this. People don't fill out surveys. Here's how you find out what sentiment is, Dom. You sit across the table from someone that actually is buying your portfolio, or what I do, my day job is talk to institutional accounts. So I'm sitting across the table from Tom Allen, who runs the mid-cap portfolio for Fidelity, who I've known for 28 years. I know from his questions, his body language, and his eyes if he's bullish or bearish. There's a completely full generation of people that because of the vid, stole that from Kevin Hart, we don't know how to talk to each other, we don't know how to shake hands, we don't know how to write, we certainly don't know how to speak. We've lost that entire thing. So sentiment stuff is a bunch of crap. Now, here's what we think's going on. We think that this is all a period of normalcy. We're heading back to normalization. I've had the good fortune of doing this for 36 years, so I think we're heading back into an 83, 84 market, 94, 95, 96 market. Think of it as Madonna borderline meets Nirvana lithium. People with borderline personality disorder need lithium to just kind of let them regulate. So through that, here's another pop culture thing. I believe that we're heading into a Jackie Moon market. Jackie Moon, semi-pro. Everybody love everybody. What does that mean? Own a little bit of everything. Maybe you should own a little sprinkle of Europe and then sell it when it works, because guess what? Fundamentally, but at the end of the day, in my view, at the end of the day, I learned the business from Bill O'Neill at William O'Neill in Los Angeles, but I also had the very good fortune of meeting Warren Buffett when I was very young. I was 8 years old when I started in the business. And he said, Brian, never buy anything unless you can reach out and touch it. So just keep it simple. Buy something that you understand. So when you hear about momentum, I feel like I'm in the movie Elf when Will Ferrell says, or Peter Dinklage says to Will Ferrell, say Elf one more time, right? I'm so tired of hearing about momentum. The momentum trade has become buy staples and utilities for no good reason, because if you're fundamental, you would never buy staples and utilities because debt-to-equity ratios are at all-time highs for those. Operating performance is down. Earnings are meh, and valuations are very expensive. So we think that you have to be much more balanced. We're going to probably talk about the 493 versus the 7. But the way to think about this is you want to have barbells in the Mag 7. You want to buy companies based on fundamentals, not just because it's cheap or growing. What their company does, what their company management is, what their product or service is, what their track record is. And when you talk about inherent stock picking, most people have no idea what you're talking about.
Okay, that was a lot.
Good morning, future proof.
I hope you guys had your coffee. I just had one cup. I may need more to digest all of that. Okay, so I was listening intently, and I'm trying to figure out how then I kind of frame around what you just said. Gabrielle, okay, no, I'm going to go to Emily first on this one. Emily, Brian laid out a whole bunch of reasons why things are developing the way that they are in his mind. It's his opinion. He's used it based on a lot of experience and history and everything else. One of the things that struck me about listening to that was the idea that the way people look at investing money has also changed or evolved over time. Brian, and I've known Brian for years now, has been knocking this momentum thing. But momentum is a factor that has become way more prevalent in the last maybe 10 to 15 years than it ever has in the past. Not that it hasn't been, but now because of computerized models, algorithmic trading, the way people construct their paradigms for how they want to invest money, those things are more important now. As a former program trader, I know it because my models for trading were based a lot on momentum indicators at times. So Emily, if these are the factors that are driving what's happening now, do we feel as though we have to change the way that we look at some of these fundamentals and macro drivers in how we select stocks?
Dom, great job unpacking all of that. I did not.
I could
impressive.
unpack it for another
Loved it.
half an hour.
I
but-
like how you weaved your way to this. We're firm believers that over time, stock prices follow profits. I learned from a lot of really smart people too, and that's one of the top things that they ever taught me. Stock prices follow earnings. And there's a reason that US equity markets have outperformed for as long as they have, is because we have higher quality earnings in the United States. We have more companies that have great balance sheets, tons of cash, great free cash flow, good return on equity. You find that in the United States. It's the tech sector. I mean, the U.S. is like a giant tech ETF, right? You invest in Europe and you're buying, banks. European banks are trading on another planet. I'm not sure why. It's not really supported by the fundamentals. You're investing in more energy companies, industrials. It's a highly cyclical trade. So what we're seeing right now is this massive shift in momentum. Did anybody see the Bank of America fund manager survey this morning? Biggest drop in U.S. equity. I know we don't like surveys, Brian. Just bear with me for a second.
He did used to work there.
I also work for a Canadian bank, so at least we have that in common. But so we saw the biggest drop in U.S. equity allocations in history. At the same time, did you guys notice that it was the biggest pessimistic move or pessimistic view on the macro environment? I looked at those two things and I laughed. That doesn't make any sense. If you have a pessimistic view on the macro environment, you're going to buy Chinese stocks? Europe is the new economic powerhouse of the world? What? If you're worried about a global growth slowdown, don't you want to buy the highest quality companies that you can buy? Those are in the United States, and guess what's even better? They're on sale. That's where we're looking right now.
Gabriella,
Fundamentals matter.
this is important right now because it's not just the B of A fund flows and fund manager survey. It's also the rash of consumer sentiment data that we've seen lately. All of these things, when I bring them out and I kind of tell experts like you, on air or otherwise, what this current state of play is, whether it's the hard economic data that may be showing signs of wavering or the soft economic data that is just outright saying things are terrible. And the one thing that I can think of in my experience is that those are all kind of those contrarian indicators, right? That you want to pick at things when people are the most pessimistic. This is not blood on the street, but it sure as heck feels as though people are not expecting things to be positive.
So since we're amongst friends, I also don't put a lot of weight on some of the soft data, the survey data, especially when it comes to the consumer. If you take a look at the University of Michigan survey, they tell you, they break it down by political affiliation. So take inflation expectations that moved higher by the most in however many years. Well, over 1 year, those that identify as Democrats think inflation's going to be at 7, whereas those that identify as Republicans think inflation will be at 0. So there is a massive political bias in those surveys. And I think the people who are answering these surveys, which are now online, that was a big methodology change, are probably leaning a bit more Democrat. And that is filtering through to expectations of the economy and inflation. So that's why we always take these soft data with a grain of salt. You could even look at ISM, manufacturing and services. They would have told you since the pandemic, there's pure stagnation. They've gone nowhere. but we had amazing growth last year. So we always take that as inputs into maybe the direction of travel for the hard data. And at the moment, all it seems that's happened is a little bit of softening in the data. That's it. We got retail sales yesterday. It seems like consumption might have downshifted from 4% in the fourth quarter to 1%. And I don't think the markets are actually pricing in anything worse than that. Because if you look at the S&P, okay, we've had a 10% correction, but it's been a 12% correction in the Mag 7. That is a very different story around earnings surprises coming down, elevated positioning, concentration, et cetera, et cetera. If you look at the rest of the market, it's just down 4% from all-time highs. So I think more the story about shifting flows is less about making black and white statements about disaster in the US, amazing stuff elsewhere, and it's more just a readjustment based on valuations, positioning. That's all I think has happened. And if an investor hadn't touched their portfolio, let's say since 2022, and had ridden that momentum of Mag 7 and US stocks, it would have left you very heavily concentrated on growth over value, US over international, stocks over bonds, and there's just a little bit of readjustment there.
I want to bring up, because each of you guys has alluded to it in some way, either directly or indirectly, about the idea that there have been certain key drivers, right? Certain things, stocks themselves, that have been responsible for some of the outperformance, or maybe even just the outright bulk of it.
Yeah.
Right? NVIDIA or whatever else. The cliche I'm going to throw out there, Brian, is stock pickers market. All right? So it sure as heck feels as though in the age of passive ETF and everything else investing that's really evolved heavily over the past 20 to 30 years, that now there has been, in the last 5 to 6, maybe even a little bit longer, since just a little before the pandemic, that if you picked the 15 right stocks, that you have been a massive outperformer against everything else. And ETF investors on a passive level, by just being in indexes that are weighted to those stocks, market cap wise, you've also captured a good amount of the outperformance that there was, the alpha that there was there. Is that the case going forward?
I think it is, and I'll try to speak slower. I got my caffeine fix out. So here's what it means to be a stock picker's market. When you take a look at the, I'm going to get a little quantity on you. If you take a look at the intra-sector performance, we do this thing in our models called standard deviation of performance. And if you see diffusion very, very high between stocks and correlation very low, that means you have to focus on stocks. If it's very high, everything's trading the same, so just buy the ETF, you're not adding any value. So what I said previously on my diatribe before was, when I walk into an account, an institutional account, they all freak out because they actually don't know how to pick stocks. Here's why they don't know how to pick stocks: because typically and historically, an institutional money manager owns 250 stocks in a mutual fund or a big account, and they just basically benchmark against the market. So they're trading around that. So what we do, we have very, very humbly that we run $10.5 billion for BMO and 8 separately managed accounts of mutual fund and ETF. The largest amount of companies that we own is 70 in our SMID cap. And we do stock picking. And so I think that the age of stock picking, like I said before, is really, Dom, understanding that Mr. Karp at Palantir is unbelievable, right? Unbelievable leader, okay? Or the product of NVIDIA in Jensen and what he's done through decades is unbelievable. So I'll just tell you a really quick story about how I bought NVIDIA. My son was a broker at Merrill Lynch at the time, and now he works for a place called First Trust. And I own this company called Activision, okay? And Activision was pumping out Call of Duty, all these updates, and I'm like, dude, how is Activision able to update the Call of Duty program all the time? And he goes, Dad, it's all about the chip. And I'm like, what are you talking about? And he goes, well, it's NVIDIA chips. I'm like, Jensen? Because I knew Jensen from my Merrill Lynch days. And he's like, yeah. And he said, I'm gonna buy some NVIDIA. Okay? So then Activision got in a little trouble with some sexual harassment stuff. So I sold all my Activision and put it into NVIDIA. Okay? And then a year later, Mr. Musk comes out and says, oh, in Tesla, we're using NVIDIA chips. So phase number 2 up. And then AI came. So sometimes you get lucky, right? So I'm just being very humble on that. You can be lucky on things, but you actually have to do the work in terms of what does the company make, Dom? How much money are they making? And I think it's not just about, you never buy stocks on valuation, you never buy markets on valuation, because valuation over a 2 to 5 year period does not work. Over a longer time period it does, but valuation is the worst metric. And I am going to debunk one thing that you said, because I actually do the research and the work on this. We publish this piece called Factor Profiles, and it goes back to 1990. The #1 investment factor in the United States stock market since 1990. Anybody know what it is? Anyone? Anyone? Bueller? It's not momentum. It's low price. You know what number 2 is? Price to free cash flow. You know what number 3 is? Enterprise value to EBITDA. Do you see momentum? Momentum's actually, since 1990, in the bottom 10. Okay, price momentum, and since 2000, it's in the bottom 20. So people get whipped around a little bit too much on momentum. So I would focus. It's always the people to my left here, much more eloquent than I. Always follow the fundamentals. That's what it's all about.
To be fair, for those people out there, I mean, I think the way that we look at it on a single factor basis is bred because we have single factor investment ETF and models right now, right? I think that for most RIAs out there, at least back years ago when I used to do it, momentum was a factor. One factor in a multi-factor model that you used to construct what you thought you were going to buy or sell, or how you were going to trade it when you got the buy or sell list from your PM by the time it was done. Gabriella, the fundamentals do matter. There's no doubt about it. At the end of the day, over the long term, a company needs to show that it can grow revenues and grow profits. That's the simple matter of the whole thing. Do we feel as though the markets right now are, I mean, to use another cliche, priced for perfection? There was this idea that, as we ramped up to record highs, that, at forward PEs the way they were in the S&P 500, that you had to kind of execute perfectly to be able to get all those. And when NVIDIA grows rapidly, but just X basis points below where the analysts thought they were going to go, you have the massive Mag 7 correction that we did. To me, and maybe others, that says the markets are maybe priced for quote-unquote perfection. Is that the case in your mind?
So I think we also follow the fundamentals, but we also think a lot about what's actually expected and priced in. So it's that magic combination of both. And I think you saw that as an example in the fourth quarter with the Mag 7 or the tech leaders, basically. Still, amazing earnings growth, 30%, amazing, great. Well, amazing's just not excellent enough when a third of the index is now made up of these companies, when portfolios are very heavily concentrated on them. And importantly, the key metric we watch to kind of get that gauge of when things could finally start broadening out are earnings surprises. And really, they've been coming down for the group as a whole, including NVIDIA, really over the past year. So the fundamentals are still there, amazing companies. It's just that we all got the point already. And all you needed on January 24th with DeepSeek was not a fundamental rethink of AI investing and American innovation. It was just another reminder that, honestly, disruption, innovation around the world is a feature, not a bug. Sometimes we got ahead of ourselves in pricing in that in one place, and maybe there's a little bit of room to readjust elsewhere. And that's really what's been driving Chinese equities higher. It's tech related to this broadening of the AI theme rather than excitement about Chinese cyclical momentum. And I think that's the same for Europe. It's not fundamentals are so much better than the US. It's more just, are we maybe at a slight inflection point where maybe Germany can grow 1%, not 0, and then maybe earnings can grow a teensy bit better, and they're doing buybacks, and they're positive rates, positive inflation, and then that's just readjusting what was met with very, very low expectations.
Emily, I see you nodding. I just want to know why.
Well, I agree with both Gabriella and Brian. I agree with Brian in the sense that valuations are not a catalyst. I wouldn't look to that as the cause of a correction, but the challenge is just the starting point. We came into the year at 22 times forward earnings. We just saw back-to-back 25+% returns on the S&P 500. That's only ever happened 4 times in history. The last time was in the late 1990s. Brian talked about the 90s. There was one time where the third year went on to produce another 25+% return, and that was in 1999. I don't want to compare this to 99. Obviously, tech companies actually make money now. But the challenge is simply the starting point. And a lot of the investors I talked to were, mad at their advisors for not getting them 25%. I'm like, you should probably fire that advisor if they got you 25% because you only own 7 stocks. And that's not good for diversification. So I do think markets are somewhat priced for perfection. We've seen a little bit of a resetting. We're at 20 times forward earnings now. Yay! But there's one thing that I would point out that we actually haven't talked about, and we've only got about 8 minutes left, is that there's one part of the market that's not sniffing out this slowdown in economic growth that we're talking about, and that's the bond market. We're not down much from a yield perspective so far this year. The aggregate bond index is throwing off 4.7% income. Like, I know this is supposed to be like cool and exciting meeting and everything, and I hate to bring up bonds because I know they're really boring, but we like bonds. Investment grade corporates are yielding 5.25 right now. I am taking that all day long. I think we're going to see growth slowing. I think this soft patch probably continues. It becomes more global. I think yields fall over the course of the year. I think inflation is much lower than people are expecting. Tariffs are wildly disinflationary. They're growth negative. And I think we're going to look back on this and realize that 4.5% on a high income bond is going to be really, really attractive here, or a high quality bond. Lock that income in for years here. You're getting a third of the risk of equity. So I think income over capital appreciation is the name of the game for 2025.
All right, that's a huge shift because
I had to go there.
No. I love it. I love it because as you point out, we have a limited amount of time left, and I'm glad you brought up what's happening in the bond market. Before I get to you, because I know what I'm going to ask you in a bit, Gabriella, what does it say to you? Forget about investment grade corporate, which tend to trade like rates, right? Because they're, in essence, they're not zero risk, but they're, if you're talking AAA, AA plus rated companies, you're kind of trading with treasuries and a spread over at that point. High yield has seen a little bit of that pullback. For the longest time, I mean, over a year, it's kind of not really moved that much. There's been a band. But in the last 2 to 3 weeks, you've seen high yield ETFs, high yield mutual funds, Gabriella, start to trade a little bit more like stocks, right? We've seen the value of those things go down and yields move higher for some of those. What does it say to you with a 10-year treasury at roughly 4.25 to 4.33%, vis-a-vis what you're seeing with investment grade corporate and spreads over treasuries versus what you are seeing with high yield debt over treasuries?
Thank you, Dom. And it's a bit of a similar story, I think, for credit as it is for the 493, which is a very mild repricing with this expectation that maybe there's a little bit of a downshift in U.S. growth. If we look at both investment grade spreads and high yield spreads, they've widened out a bit over the last few weeks, but just to levels where they were in September. So from very low levels, similar to the 493, which have just corrected 4% from February all-time highs. So I think that's all it's telling us, just a mild slowdown, mild risk-off being priced in. But when we think about the difference between investment grade and high yield and bonds in general, which we do like as well, is when you think about, do I want to take risk? The question is high yield or equities. They should be thought of as a way to express risk. So I think if the intention is to lower a bit the overall risk in a portfolio, then that's a conversation about taking some profits in equities and high yield and rebuilding the long forgotten core fixed income portion of a portfolio. And I think what the market is telling us this year is that we're in this environment where there's going to be a bit of a tug of war between slowdown risks, where we are right now, and then core fixed income can really help you. The 10-year has moved lower by 50 basis points, especially in February. It really helped you when there was that first growth slowdown fear. But eventually we might get to another side of this tug of war. Maybe inflation becomes top of mind again. Or there is a massive tax cut bill making its way through Congress. Maybe fiscal comes back as a risk. And then you're in this tug of war. And to help with those other two type of risks, public markets aren't really going to help you. What helps are hedging strategies, systematic hedging of some risk exposure, plus certain pockets of the private markets, things like infrastructure, real estate, hedge funds, which are totally unrelated to public markets. And if I may, just one last thing from my side. I've been very jealous of Brian's amazing tan.
Also the sweater hoodie. Sweater
And the
hoodie
sweater
blazer.
hoodie.
It's a sweater hoodie blazer, I think is what it looks like to me.
But especially the tan. I'm Brazilian. I grew up in Brazil. So being here is like being in Rio de Janeiro, just chatting here on the sand. And I think a lot about, I used to play a lot of like beach soccer. And this analogy around diversification, it's very similar. You know, you need not just the attackers that are there to score points, but if you're actually going to win the game, if you're actually going to meet the scoreboard, you need a variety of defenders. And so I think we're in this environment driven by policy change, geopolitics, starting points where you need multiple defenders here to help with various shocks.
Okay, so with that, we're going to run out of time here soon. I could stay up here for hours, by the way. But Brian, I'm going to kind of maybe start the wind down with you first. And the very kind of simple and open-ended question for you is, given your experience over your career, are we in a bubble?
No, next question. Obrigado, by the way. Obrigado.
De nada.
So, real quickly, because you haven't heard what we actually think. So here's what we actually think, okay? Let's go back to everybody love everybody. I think you want to be in value, you want to be in SMID, you want to be in dividend growth. Dividend growth is buying companies that have cash flow yields above the dividend yield, that dividend yields above the market, that have positive earnings. You're not just buying high yield companies, you buy companies that are building the dividend. You also want to be in some tactical stuff. You want to barbell the Mag 7 and overweight the stocks that represent the Mag 7 in technology, consumer discretionary, and communication services that aren't Mag 7. You don't have to be underweight all the Mag 7. You should be overweight a couple of them. That's our official recommendation, $6,700 and $275 on the S&P 500. Boom. Now, on the bubble, just because asset prices go up does not mean it's a bubble. Here's when it's a bubble, when everybody and their mother, brother, sister, cousin, uncle's making money. Back in 98, 99, 2000, we were doing stupid-ass stuff, like evaluating companies with billable people walking down the street. You had rock star analysts, rock star bankers. The investment world was making money hand over fist, and that's when bubbles happen, when everybody's making money. No, there's no deals in AI. There's no M&A. This has been the slowest M&A environment, slowest secondary environment in investment banking history. There's no bubble. There was a bubble in 2008 as well because everybody is making money. Nobody made more money on Wall Street than they did in 2007, including myself. So I've never made as much money as I did in 2007. It's a massively different environment, so that was a bubble as well. We are nowhere close to a bubble, Dom. Thanks for the time.
All right, Emily, before we're going to kind of, same question for you. I'm not going to say, is it a bubble? You can address it if you want. Brian laid out some of his strategies for how he's viewing how to approach the market. What's your recommendation out there?
Yeah, I mean, I think we are doing some pretty dumb stuff. We have a cryptocurrency called Fartcoin that has a bigger market cap than a quarter of small cap companies in the United States. Like, we've got to be careful. That's our sentiment. And sorry, it wasn't very ladylike to say that. I know that, but
There's been worse.
That's our sentiment indicator. We've seen a lot of risk taken in areas, growth at any price type companies that don't make money. 40% of the Russell 2000 index is comprised of companies that are unprofitable. We want to be careful about that right now. I agree moving down into mid caps, That's the sweet spot for us. That's our diversification away from high-quality U.S. technology companies. Industrials is the biggest overweight there. The U.S. is benefiting from a massive manufacturing renaissance right now. We see U.S. mid-caps, industrials, think Midwest, all benefiting from that. And then balancing that out with that high-quality bond exposure, investment-grade corporate bonds, we think are really a nice way to play portfolios for the remainder of the year.
I think we're just in the not a bubble. I think we're just in the middle of a bit of a repricing around Meg 7 earnings expectations and also repricing the U.S. growth profile as a result of some of this policy fog. That doesn't mean we don't want to own risk. I think it just means that we have to be careful about some of that drift that has happened in portfolios since 2022. So it means rebalancing from the growth to value, rebalancing and making sure we have core fixed income. And yes, it includes the U.S. and rebalancing closer towards a neutral allocation in our national stocks. That's just public markets, but everyone here has much more of a chance now, right, to complement that with private markets. And the area that we have the highest conviction there to help with uncorrelated performance is infrastructure. And in terms of a starting point in valuations is real estate. So a lot to do amidst some of this very normal repricing we're seeing.
And there's going to be a lot of programming, I'm sure, over the course of the past couple of days and into tomorrow that's going to address many of those asset areas as well. I want to thank you guys very much for letting me be up here because, as you guys know, if you watch CNBC Air, each one of these guys maybe speaks for about 6 minutes at a time every time we're on live television. This has been a real treat for me, having 40-some minutes with these guys. So thank you very much, Gabriela Santos, Emily Rowland, Brian Belsky, and I hope you guys enjoy the rest of the programming here. We'll see you later on this afternoon.